Today we will be discussing debt and equity investments from the perspective of the investor. Investments can be classified as either short-term or long-term. Short-term investments are securities that management intends to convert into cash within 1 year or the operating cycle, whichever is longer, and are easily convertible to cash. Short-term investments are classified as current assets. Long-term investments are either not easily convertible to cash or are not intended to be converted into cash in the short term. Long-term investments are classified as long-term or non-current assets. Investments can be further divided into either debt or equity securities. Debt securities include a creditor relationship, such as investments in notes or bonds from another company or by governments. Equity securities are investments in stock issued by corporations. Based on the criteria we have discussed so far, as well as some additional key details yet to be discussed, all securities can be broken down into 5 categories, including held-to-maturity securities, trading securities, available-for-sale securities, securities with significant influence, and securities with controlling influence. Each of the 5 categories have associated reporting rules that must be followed. The remainder of this video will focus on held-to-maturity securities, with subsequent videos focusing on the other 4 types of securities. Let's talk about the first of the 5 security types, held-to-maturity securities. You can think of the word maturity as day when the principal on debt securities is due, such as the final day of a bond's life. So held-to-maturity securities are investments the company plans to hold on to until the end. Since equity securities like stock do not have a specified maturity date, held-to-maturity securities are never equity securities. Rather, they are always debt securities, such as investments in bonds that have a fixed life, like 5, 10, or 30 years. Also, held-to-maturity securities can either be short or long-term. The accounting procedure associated with held-to-maturity securities is to report them at what is called amortized cost, which is discussed in more advanced accounting courses. In this class, we only discuss the case when the purchase price and the maturity value are the same, which simplifies the journal entries. The journal entries for held-to-maturity securities are relatively straightforward and introduce no new concepts that you haven't been exposed to in other chapters, but we will still go through a quick example. Assume that Ellison Enterprises paid $10,000 on June 30, 2019 to buy Apple's 4% 5-year bonds payable with a $10,000 par value. The bonds pay semi-annual interest on January 1st and July 1st. Ellison Enterprises intends to hold onto the bonds until they mature in 5 years. First, we must do a journal entry for the purchase of the bonds, which includes a debit to long-term investments and a credit to cash for $10,000. Next, on December 31st, 2019, there needs to be a journal entry for the interest earned in 2019. This will include a debit to interest receivable and a credit to interest revenue for the interest payment equal to $10,000 multiplied by 4% or 0.04 multiplied by the relevant fraction of year, which is 6 out of 12 in this case. This gives us $200. For the first interest payment on January 1st, 2020, we debit cash for $200 and credit interest receivable to close out the balance from the previous entry. There would be 9 additional interest payments, but we will skip to the maturity date of the bonds on June 30th, 2024. On this date, the $10,000 par value is received. This will include a debit to cash and a credit to long-term investments for $10,000. Alright, that wraps up all the journal entries that I wanted to cover in this video.